Hello, everybody. Hello. Good afternoon. Welcome back. I want to thank Energy Disruptors for inviting me along to speak this afternoon. It's the most fantastic conference. Isn't this a great event? I have to say, I go to a lot of energy conferences in my life, as you might expect, and I genuinely don't think I've ever been to one with as much enthusiasm and excitement as this one. So, as I say, it's really great to be here. I think it's a very well-chosen title as well, Energy Disruptors. It's very clear that disruption is a very accurate term for what's going on in the energy industry right now. And disruption is also one of those great words. I think everyone likes to talk about disruption. Everyone likes disruption. Everyone likes disruption, except when it happens to them. And that's really what I'm going to be talking about this afternoon. In the next 20 minutes or so, I'm going to be talking about the companies that are being disrupted, the old established players in the energy industry, the big oil and gas companies, sometimes known, I think people would say, the dinosaurs of the energy industry. I'm going to talk about the pressures they face and some of the ways that they've been responding to those pressures, and they are trying perhaps to disrupt themselves in the face of all these changes that are going on in the industry. I wanted to start this talk by throwing a few numbers at you. The numbers are as follows. They are Chevron 2.2, Shell 2, Exxon 1.5. Anyone care to hazard a guess? No? So those numbers they are the percentage increases in the share prices of those companies yesterday in what I'm sure you will have noticed was an absolutely momentous day for the oil market. Oil prices, the price of Brent crude, actually went up by 13% yesterday. There's been, because of the attack on Abqaiq, the Saudi Arabian oil processing facility over the weekend, because of that, I think there's been quite a profound shift in people's understanding of the global oil market. I think what was sort of hidden in plain sight, the issue of the vulnerability of world oil supplies to disruption in Saudi Arabia, that's really been brought right to the front of people's minds again. That's been absolutely put back on the agenda, and I think that's going to be something that people are going to be thinking about very deeply and with a great deal of concentration for years to come. So given this, as I say, really very important day in the oil market yesterday, it's pretty striking that the reaction for the oil companies, the biggest oil companies, was kind of a shrug. It was a meh, really? Okay, is this a big deal? It seems not. So why was that? I think the reason why was that there is a really profound skepticism among investors about the prospects of the big oil companies. I think that people really think those companies don't have a great future ahead of them. I think people are very concerned about a lot of the pressures those companies face in the disruption of the energy industry. And what I'm going to do now is talk about some of those pressures and the ways that companies are attempting to respond. The first pressure, I guess, a very obvious one. We talked about it quite a lot already today, but I wanted to focus on one particular aspect of it. First issue is climate change, clearly. It's absolutely obvious to everyone. I think the concern about climate change is mounting, and we are seeing governments responding to that in all kinds of ways. Most famously, I guess you would say, in the Paris Climate Agreement of 2015, but there have been lots of other policy changes as well that have really significantly affected what companies are doing in terms of trying to cut emissions and boost renewable energy. There's a list of just a few of them selected here on this slide. A couple of noteworthy ones. I would point you towards the UK and France, which both have commitments to be carbon neutral. In other words, they are aiming for zero net carbon emissions by 2050, and in France they've actually passed a law committing them to that target. Another two things I think are interesting and important to think about are what's going on in China, and actually not on that slide, but another one I would point you towards is India, where these are countries, these are emerging economies, where you might think they don't have climate change as their top priority. They have all sorts of other priorities in terms of economic growth, development, social services, and things that they care about. But they are also putting in place policies to curb the growth of their emissions and to boost renewable energy. So, as I say, a lot of policy change going on in a lot of different places. But it's not just the governments. There's also a lot of interest from the private sector in climate change and the climate issue and what it might mean. Some of the people that are particularly concerned about this are the big investors. If you think about big insurance companies, pension funds, they're looking at their investments on very long time horizons, 20, 30, 40, 50 years, and so on. And over those time horizons, it's very possible that climate change will increasingly come to be an important issue. And so they are worrying about that now and thinking about climate risk in their portfolios. And we've seen that in this very sharp increase in climate-related shareholder proposals at US companies. If you look at these numbers here, so you can see that in the early years of this decade, there was typically about sort of 30, 35 climate-related proposals a year put forward to the annual meetings of US companies. And that's gone right up to about 85 proposals or so a year at the moment. That last bar seems to show a slowdown, but you can see that's just actually for the first 7 months of the year. If you look at 2019 as a whole, I think it's pretty clear that, again, we'll have seen a very high level of shareholder interest in the climate issue. Thinking specifically about what that's meant for oil companies, here's a timeline of the way that that's affected some of the oil companies. And you can see here there's been a range of responses, and sometimes companies have tried to resist what shareholders have wanted them to do. We've had shareholders, for instance, suggesting that oil companies set firm targets for cutting their greenhouse gas emissions. On the whole, companies have rejected that, although Shell has been one interesting outlier which has actually gone along with that and has said, yes, we will set targets. But in other cases, there's been very broad acceptance across the industry that they need to respond to shareholders' concerns. And one very good example of that is these 2-degree reports. Some of you may well have heard of these, but this is where companies are producing reports where they really set out their expectations for the future of their business of what would happen if governments put in place policies to meet that goal of the Paris Agreement of keeping the rising global temperatures to well below 2 degrees centigrade. So there's been a big difference certainly in the way that companies think about climate change and the way they talk about it, and that's really been in response to shareholder pressure. The other thing then, beyond the climate issue, there's something else we've heard about quite a bit already today, rapid technological change, which has made renewable energy much more cost competitive. This is just one example. I won't go through lots of them, but here's solar power, for instance. You can see in a number of different countries, these are actual outturns for what solar power cost in those places last year, and this is the Wood Mackenzie forecast for what it's going to be in 2023. You can see continuing declines expected. Interesting thing about this is I think if you compare cost of solar generation to the cost of gas power generation, which has typically been the most cost competitive form of power until recently, gas generation typically costs anything between $50 and $100 per megawatt hour. And so you can see that already in many countries, solar power is the cheapest form of power generation, in some places by quite some distance, and it's going to become even more competitive in the years to come. So that's really presenting a very serious threat to demand for gas. Partly as a result of that, the oil and gas sector has been a really terrible investment. This is what's happened since 2014, start of 2014. You can see that's the US S&P 500 index on average has done really very well. It's been a great time to be an equity investor. Total shareholder return there has been 80% since the start of 2014. But if you've been an energy investor, it's been really pretty horrible. That total return in the energy sector, the lower darker line there, that's actually been negative. If you've been investing in energy over that period, you've lost 22% of your investment. And that's left a lot of investors, I think, very unhappy about the performance of energy. Looking forward, again, it doesn't really look like oil and gas is where the growth is. These are Wood Mackenzie forecasts for what energy demand we expect will do over the next 20 years or so. And you can see that bottom line, the pale blue line, that's coal, roughly flat, probably not going up, maybe going down a little bit. Oil, some growth, and probably growing a bit into the 2030s, probably topping out sometime in the late 2030s and then starting to decline. Gas, maybe a bit more growth, but definitely, clearly, the strongest growth, we think, is going to be for electricity. And that's renewable electricity within that, probably even more strong. So if you want to be where the growth is, if you want to be in the market that's going to give you growth, electricity is really where you want to be. It's also interesting because there's potentially quite a big opportunity there to create an electricity supermajor, or renewable energy supermajor. When you look at the electricity companies around the world, they are, by and large, not as big as the biggest oil and gas companies. You see here on the left-hand side there, those are the 3 biggest listed oil companies. ExxonMobil worth about $300 billion, Shell and Chevron worth about $230 billion each. And those are 3 of the biggest power companies, NextEra Energy of the US, Enel of Italy, Iberdrola of Spain, and you can see they're all significantly smaller. Even the biggest players in power are not on that kind of what you would call the global supermajor scale, and that, it looks like it creates possibly an opportunity. There have been attempts to get to that supermajor scale in renewable energy. Some of you may remember the sad story of SunEdison. SunEdison was a very ambitious, fast-growing solar power company, and very explicitly aimed to become a renewable energy major. Its chief executive said back in 2015, Exxon was the target they were going for. They wanted to be an Exxon-scale renewable energy company. Within 18 months, though, that company sought Chapter 11 bankruptcy protection. It didn't quite work out for them. Things haven't been great for Exxon over that period. They were even worse for SunEdison. So I think if you're an oil company looking at that market and you're looking at the potential there, I think you're thinking there could be something we could do here. When Shell, for instance, Shell has talked about possibly being the world's largest power company by the 2030s, it's not obviously crazy, right? That is possibly something that they might be able to do. So what's that meant? Well, it's meant a fair amount of M&A activity. We've seen quite a few deals done, particularly by the European oil and gas companies seeking to acquire positions in the power business. Just a few of them, a few of the headlines here. Total bought a controlling stake in SunPower, which is a solar power company. Shell buying a company called First Utility. BP getting into solar power. BP is a bit of a circle of life case. BP was really the first oil and gas company into the renewables business, decided that it didn't work, pulled out again. It had a solar business which it sold. Now it's got back into solar power again because they think that even though it's been difficult for them in the past, they think there's some potential in it. And here's a more detailed look at all this corporate activity that there's been, particularly stepping up really in the last few years by the big European oil companies, Total, Shell, Equinor and BP. Equinor, there's an interesting little story right there, right? That company used to be called Statoil. It was a Norwegian national oil company, but they decided they wanted to change their name to show that they weren't just going to be an oil company anymore. They were a full spectrum energy company. And as you can see, they've been doing lots of deals in renewables, energy storage, buying electricity supply, and in electrical vehicle charging as well. So the amounts of money spent often by the standards of these companies are not huge, but it's not trivial either. If you look at Total, so the thing to think about here are the yellow triangles. The yellow triangles show spending on these new energies as a proportion of spending on upstream oil and gas production assets. And you can see that for Shell, that proportion, that's 25%. So that's a pretty significant chunk of their total investment. For Eni of Italy, it's been about 10%. For BP and Shell, it's actually been a lot lower because those companies have been making pretty big investments in oil and gas assets, but those proportions definitely could rise. Shell has been talking about spending $4 billion a year potentially on new energies in the 2020s, and that would be probably 15, 20% of their spending. So it's not the majority of their spending, but it is a significant minority that they could be committing to these kinds of energies. Still, as I said, it's not the majority of their spending, though. The majority of their spending is still over that period going to be going into oil and gas. Oil and gas is still where all the profit is made, and oil and gas is undoubtedly going to have a future for decades to come. If you look, this is the example for oil. Think about the outlook here. So that top line is that Wood Mackenzie forecast for total oil demand that I was talking about, that darker line. The one underneath it is an interesting one, that sort of pale gray line. That's the line for oil demand projected by the International Energy Agency in its 2-degree scenario. So that's saying, imagine a world where governments, as I say, do make the commitments needed to hit the Paris target of keeping the increase in global temperatures to below 2 degrees. That's what oil demand, we think, could look like. So it's basically on a gently declining curve. And then you've got to think about the solid blue block at the bottom there, which is oil supply from existing assets. So that's everything that's currently in production, what supply do we expect to get out of that in the future? And you can see because of natural decline, of course, that goes down. And so by 2030, there is a pretty significant gap even in the 2-degree scenario, and even more so if you accept the Wood Mackenzie base case and you think demand is going to grow a bit more. And so that gap is saying there is going to be a need for new investment. Companies are going to need to put more into oil production. But as I said, They're under all this pressure from governments, pressure from investors. They're going to have to run their traditional oil and gas businesses in different ways. And one of the things clearly they're going to have to do is work on curbing the emissions from those businesses. And we've seen oil companies set a number of different targets and objectives for reducing emissions, some sort of short-term, immediate things that they're doing, some longer-term, a bit more aspirational goals. But as I say, there's a lot of activity going on there. As I say, a few examples there on that slide, kind of things companies are doing. They are cutting their flaring, they're cutting methane leakage from both their gas and their oil operations, and a lot of them are also getting into carbon capture and storage in various ways, pilot projects, and some now, just a few starting to come in that are actually operational and really making carbon capture work. Interesting sort of precedent here in Canada. Again, this chart probably familiar to quite a few of you. This is emissions from companies operating the Canadian oil sands. Of course, Alberta has got very early experience with regulating emissions from oil production. They've had regulations in place in terms of emissions intensity. That's kind of greenhouse gas emissions per barrel of oil produced. Those were first put in place in 2007. And it's pretty clear they've had quite a significant effect. As you can see there, really steep drop over the period 2020 to 2017. And people are expecting continued declines in the future. Just this month, we had Suncor announcing big investment, $1.4 billion. Again, I'm sure a lot of you saw this, $1.4 billion investment in its upgrader at Wood Buffalo, which is intended to cut emissions there by 25%. That's really a very significant amount of money being spent with a very significant payoff in terms of emissions. And so those kind of things we do expect to keep Canada's emissions continuing to fall in terms of emissions intensity at least, although it's certainly possible that overall emissions would still rise as production rises. But anyway, conclusion from that is where you get to is the point where someone like Canadian Natural can make this claim. This was in their stakeholder report from last year, which I think is a really fascinating statement, saying Canada is well positioned to be a global supplier of a premium low carbon emissions intensity product for decades to come. That's a really striking thing. I mean, still, generally, Canadian oil sands production is at the higher end in terms of emissions intensity when you compare it to other crude production around the world. But that's Canadian Natural very explicitly making that statement. They believe they can be a low carbon intensity producer and would actually sell their oil and market it to people on that basis. So I think that's a really interesting development. So, question, what are we to make of all this activity, all this, the rhetoric and the investments by these oil companies? The obvious critique, clearly, is it's greenwashing. This is just something done to kind of dress up and put a nice face on their traditional oil and gas business, which is still what it's always been. There may be some of that. I don't quite buy that for a couple of reasons. One is, I think if it is just a PR exercise, it's a very expensive one, right? These are many billions of dollars are being spent, and you could probably arrange to do a PR company, you could hire a PR company for a bit less than that. And I also think when you talk to investors in the oil and gas business, when you talk to executives in the oil and gas business, and they're responding to pressure from investors, when you talk to the executives, they really seem sincere. And maybe I'm being naive about this, but I think people are genuine. I think people see the pressures they're facing. They don't think those pressures are going to go away. They want to be in business for the long term, and I think they think that in a world where there is going to be growing pressure on carbon emissions, where renewables are going to grow, they need to change in order to adapt to that world. One of the things we've learned, I think, for certain about the energy industry in the past couple of decades is it's full of surprises. 2 decades ago, who would have thought that the US would this year be the world's largest oil producer? Who would have thought that solar power would be providing the cheapest electricity in the world? I think those are things that no one expected. And so you have to be ready for a potential range of outcomes. What the companies are doing with these investments in renewables is buying themselves options where they could be in a world of much greater renewable energy, much tougher controls on emissions, they could remain successful. As I said, it's commonplace to talk about these companies as being dinosaurs, the energy industry. Of course, as anyone who knows anything about dinosaurs knows, dinosaurs are still with us, right? You need to go outside and you see them. The dinosaurs' descendants are flapping around every day as we speak. They're still here. And I think there's an interesting parallel potentially there. I think it's certainly possible to imagine that the energy dinosaurs could survive in a new world, but they may just need to grow feathers and learn how to fly. Thank you very much.